You have $4,823 on a credit card. You've seen it on the app. You know the number the way you know your own address, automatically, without thinking about what it means. Here is what it means. Your bank is not calculating that balance once a month. It runs the calculation every single day. Daily periodic rate, 0.0684%. That is 24.99% APR divided by 365, not by 12. Before you open your eyes tomorrow, the number has already moved, silently, in a direction you are not watching. 167 million Americans carry a credit card balance. 46% pay only the minimum each month, not because they don't care, because the minimum is the number printed in bold on the statement. It was designed to be paid. You are 28. You've heard the term compound interest. A teacher said it once, and you filed it under things that would matter later. What no one said is that compound interest is not a concept. It is a mechanism. The same mechanism that turns $500 into $3 million over 40 years inside an index fund is running right now against your $4,823. Same formula, same arithmetic. The only difference is which side of it you're standing on. Level 1. The minimum payer. You earn $58,000 a year. After taxes, rent, and the car payment, you have enough to function, not to build anything. Minimum payment due, $97. You pay $97. You set auto pay so you don't have to think about it, which is exactly what the system is counting on. What the statement does not show. Pay only $97 every month, and you will be paying this balance for 23 years. Total interest, $11,420 on a $4,823 principal. The information exists. Nobody searches for it. Every night, the balance compounds. 0.0684% of whatever you owe, added before dawn. No sound, no notification. Tuesday evening, Trader Joe's ramen, $1.99, eaten standing at the counter. Your mom called. You let it go to voicemail. You check the app. Looks the same as last week. You think, still manageable. You are not managing it. You are watching it from the wrong side of the glass. 3 months later, the balance is $5,140. You didn't spend $317. The mechanism did. Then a mailer arrives. Pre-approved personal loan, 11.99% APR. Level 2. The consolidator. You are 30. One card became 3. Balances, $7,200, $6,400, $4,800. Total, $18,400. You remember maybe one of the purchases. The rest dissolved into months that no longer have edges. SoFi, $20,000, 11.99% APR. 60 months, $445 a month. Approved in 11 minutes. You zero all 3 cards the same afternoon. Relief. You feel it in your shoulders first. 45 days later, your FICO moves from 681 to 704. You screenshot it. You send it to no one. 4 months after that, one card has $2,100 on it. Tires, $680. A medical bill, $740. A work trip you had to front. The limit was still open. You used it. You are now running 2 compound cycles in parallel, the loan at 11.99% and the card at 24.99%. Both calculating daily, both pulling the same direction. Consolidation did not reduce the debt. It repackaged it and left the original container open. The loan extended your timeline by 60 months and freed the ceiling on the same day. Your birthday passes mid-work week. You eat cold pasta at your desk. You don't think about it. 6 months later, a mortgage lender runs your numbers and says there's a figure you need to know. Debt to income. There's a ceiling, 43%. Level 3, the maxed borrower. You are 33. Gross monthly income, $5,200. Obligations. Auto, $380. Student, $290. SoFi, $445. Credit minimum, $725. Total, $1,840. DTI, 35.4%. 30-year mortgage, fixed at 7.1%, monthly $1,620. New DTI, 41.9%, under the ceiling. Approved. You sign, you get the keys on a Thursday, you walk through the empty living room and feel something you decide counts as proud. What 41.9% means: every dollar of margin you had has been structurally allocated, not spent, allocated. A car repair, a tooth, a week without work, any one of those now pushes you past the ceiling with nothing to catch the difference. You stopped being a borrower the day you signed. You became a profile, a row in an underwriting model, utilization, payment history, DTI, default probability. You qualified into that identity. The $1,200 HVAC estimate arrives in September. You sit in the parking lot for 6 minutes running the math against the monthly budget. Then you go in. If you've made it this far and any of this lands, subscribe. The next 3 levels don't appear in personal finance content. 14 months after closing, the company restructures. Your role is eliminated. Severance, 6 weeks. Savings, $1,200. The mortgage is due in 19 days. Level 4, the collateral. You are 35. You found work again, $51,000, which is $7,000 less than before. The mortgage is current, barely. The card balances came back. Total unsecured, $22,600. The math doesn't close. A broker calls. Cash out, refinance. $47,000 in equity. You can pull $30,000 out. New rate, 7.25%, higher than your original 6.1%. You sign anyway. $30,000 is the only number large enough to solve the immediate problem. You pay off the cards. 3 months of overdue utilities. You close the laptop and sit in the kitchen. The silence feels different. 6 months later, you open a HELOC, $25,000 line of credit. You draw $14,000 immediately. Wednesday, 7:14 a.m. You walk out the front door. The space where your car was parked is empty. Repossession. You recover it. $1,840 in fees. 3 days. The first $600 pulled from the HELOC. That night, you spread every statement across the kitchen table. Mortgage, refinance, HELOC, auto, SoFi, month 47 of 60. The number resists being a single thing. It is layered. Each layer secured against something you have been calling yours. Secured. You look it up at 11 at night. An obligation backed by collateral. If the debt wins, the collateral transfers. The house was never yours in the way you understood ownership. It was a position. You were living inside leverage that belonged, in the legal sense, to the institutions on the other side of every document. You sign more paperwork. You read enough to find the signature line. Every signature is a small, legal transfer of something, incremental, in a direction you are no longer tracking. Then your phone rings. Unknown number. The voice says they are the current creditor. Level 5. The garnished. You are 37. The account is a card you stopped paying 2 years ago, when the choice was that payment or the electric bill, and you chose the electric bill, until the bank made a different choice. Charge off. Balance, $9,200. The bank wrote it off and sold the portfolio. Your $9,200 went for 4 cents on the dollar. $368. You were not notified. The transaction was between 2 financial entities. You were the underlying asset. The debt buyer filed suit. The summons went to your previous address. You never received it. The court entered a default judgment, automatically, in your absence, for $9,200, plus 9% post-judgment interest, plus attorney fees. You find out on a Friday. Direct deposit lands $340 short. Wage garnishment. 25% of disposable earnings, every pay period. A judgment lien also attached to the house. You pay $200 for a consultation. Statute of limitations in your state, 6 years. The debt buyer filed at year 4, month 11. 1 month later, and the claim would have been time-barred. It wasn't. She finds a second account, $4,100, resold 3 times. No entity in the chain has the original signed agreement. The debt exists as a number passed between spreadsheets. Zombie debt. 2 years ago, you paid $25 to stop the calls. That payment reset the clock. Your daughter turns 9 this month. Her school play is Thursday evening. She's been practicing in the car for 3 weeks. You are not there. You were in a strip mall office at 11:30 at night with a bankruptcy attorney you found through a Google search. Chapter 7 or Chapter 13? If you're still here, subscribe. What comes next is what the system officially calls resolution. Level 6, the discharged. You are 39. You chose Chapter 7. The means test passed because garnishment and a second pay cut had dropped you below the state median. You paid the attorney $1,800 in 3 cash installments. Your checking account had a levy on it. The 341 meeting lasted 9 minutes. Car, $6,400, under the exemption. House, $31,000 remaining equity after the refinance, the HELOC, and the lien. The house did not qualify for homestead. The house was liquidated. You had 60 days. Your daughter started at a new school on a Monday in March. She didn't complain. That was harder than if she had. Total discharged, $74,300. The garnishment stopped. The calls stopped. 11 months later, IRS Form 1099-C arrives. A separately forgiven medical debt, $12,000, reported as cancellation of debt income. The IRS treats forgiven debt as income, literally. You owe $2,640 in federal tax for a year in which you lost your house. Your FICO sits at 487. The bankruptcy stays on your report for 10 years, not 7, 10. Discharged, free in the procedural sense the court recognizes. What discharge does not do is remove you from the system's memory. Your profile was reclassified. Within 90 days, pre-approval offers arrive again. Secured card, $300 limit, 29.99% APR. The product exists specifically for this moment. The machine had the next instrument ready before you signed the papers. There is someone who never appeared in any of these levels. His name is Marcus. He is 31. He works at a debt acquisition fund in Wilmington, Delaware, a building with no signage, no consumer-facing website. Its clients are the 14 largest banks in the United States. Its product is the balances those banks decided were no longer worth their own time to collect. The fund manages $2.4 billion in AUM. Average acquisition price, 4 cents per dollar face value. Average recovery, 12 cents. The spread is 8 cents. IRR target, 18%. Last fiscal year, the fund exceeded it. Marcus sits at 3 monitors. Each screen displays tens of thousands of rows. Name, last known address, balance at charge-off, estimated recovery probability. Your name was in one of those tables. Your $9,200 was acquired for $368. That is not an estimate. That is 4 cents on the dollar applied to your specific account. Marcus did not call you. A predictive dialer did. Marcus did not file the lawsuit. A contracted firm did, one of several handling several thousand cases per quarter. Marcus did not appear in court. A clerk entered the judgment on a Tuesday afternoon. The same way mail gets sorted. The garnishment that took 25% of your paycheck for 14 months ran through your employer's payroll processor. Automatic, compliant. Marcus received a quarterly report. Q3 recovery rate, 12.7%. His bonus reflected the improvement. Marcus is under contract on a 2-bedroom condo in Fishtown, Philadelphia, closing next month, 20% down. He has never seen your face. Your debt was not a relationship. It was a position, a yield-generating instrument acquired below par, recovered above cost. In the fund's internal language, your account was a performing asset in a distressed consumer debt portfolio. Every stage you move through, The consolidation, the refinance, the charge-off, the judgment was already a predictable point in the acquisition model. The 4-cent price already priced in legal action, already priced in 14 months of garnishment, already priced in bankruptcy discharge. The losses were priced into the spread before your name entered the spreadsheet. You did not lose to a person who made better decisions than you. You lost to an asset class built around the specific financial conditions your life produced. Somewhere this morning, a 23-year-old opens an email, pre-approved, Citi double cash, APR 24.99%, 2% cashback. He thinks this is about cashback. He thinks it's about building credit. He clicks apply. The form takes 4 minutes. He does not know the interest compounds daily, not monthly. He does not know that his name, his zip code, and his predicted spending behavior already exist in a scoring model maintained by a data broker in Wilmington before he finishes the application. The machine does not stop. It does not distinguish between the saver and the borrower, between the disciplined and the overwhelmed. It distinguishes between one thing: who sits on the side that issues the credit and who sits on the side that receives it.